Good morning, ARMR Insiders. Welcome to the morning meeting. Thanks for joining, everybody. This is the time we get our heads straight and get ready for the trading session. So let's talk about big picture first. Look at the indexes, where we are, where the risk monitor is. Talk about top stocks we're looking, type of research we're doing, and then drill down into our day trading practices and what we're trying to achieve today. What is the play out of the ARMR day trading playbook that's at the top of the list today? So if we see it, we trade it, and we trade it aggressively. So don't forget, what I'm doing here is sharing with you my own personal approach. It's the ARMR investing way. And I've been doing this over 30 years, running my own capital, managing capital for others, building algorithms, and I'm sharing that information with you. So take it for what it is. Do your own due diligence. Make sure you match your risk tolerance to the processes we're involved in here. Diving in. First thing we want to look at is the S&P 500. Okay. So this is our guide for what the market can be doing. So what we see here is a test of the January low. So what I would submit to you first is, I like to read the Investor's Business Daily, and I like to read over what the options position is following SpotGamma. Those are the two things I do before I even start to write the captain's note for you in the morning. I kind of think of it as banging the goalpost. All right, I want to see where I am in net, make sure I'm positioned correctly from a thought process. So the IBD has its own version of a risk monitor, and that risk monitor has been flip-flopping from red to green to yellow. They've been on a failed green signal for the last couple of weeks, and they've called it yellow. They've yet to flip red. The basic premise of the Investor's Business Daily, reds, greens, and yellows, is not a very complicated algorithm. It's just simply looking at volume and interpreting that as institutional support or resistance. They call it accumulation or distribution days. And so they actually answered the question I've been thinking the last couple of days. How could they still be yellow with all these distribution days piling up and failures everywhere? Are they going to wait for a new low in the market before they go red? And if they do, how does that help anybody? But I digress. The answer to that question this morning, they actually wrote, which is, they're not going to go red unless the market takes out the low of January. And I mean, doesn't seem very helpful to me, but I do get their point. So I share with you this chart again. Until we take out the low of January, this rally attempt is still in force. So what it's done is go up to the 50-day, which is the black line, fail, come down and test. If it holds and gives another buy signal day, then you got a double bottom. And this is where the ARMR algorithms come in. It could be pretty interesting. We've been on risk monitor red since December 3rd. We flipped yellow for a week and went back to red. We flipped yellow. We have 7 algorithms written for the 7 different indexes we use. And our approach is a bit different from IBD in the sense that I don't really use volume as a source to tell me if institutions are coming or going. I feel it's a little bit antiquated, even though I still respect it and I read the IBD. What we look for is confluence across the market. We're in a market, particularly in the last 5 to 10 years, in the last 5 years, and it seems to get more and more accurate. We're in a market that's highly correlated. Everything goes up and down at the same time. And I'll carve out commodities and put them over here for a minute because they can do something different in an inflationary environment, and that's what we're seeing. But the big picture of the indexes we follow, the 4 big indexes, S&P, NASDAQ, Dow, and small cap. If those 4 all tell us the same thing at the same time within like a 24, 48-hour window, it can change the risk monitor color from red to yellow. But if we don't get confirmation from the secondary indexes, momentum, value, IBD 50, which are innovators, then we really never get green, right? So it's possible we flip to a yellow at some point this week. If this bottom holds, the market goes higher and we get a double bottom in place and all four of the big indexes give us the same signal, we'll flip yellow. And what that'll mean to me is to me, that would be a rally in a bear market. A tradable rally, I'm happy to admit, but a rally in a bear market. So it would stop me from running out there and trying to buy everything in sight and try to build out all the stocks on my whiteboard and start owning 15 or 20 names. There's no way I'm doing that. I need risk monitor green for that. If we get a yellow signal, what I will do is I will hold indexes overnight for a swing trade. I talked about it yesterday on the live trading desk at the end of the day. I said, we're on a day trade that's working. We were making money. I'll show you in a minute how we made money yesterday, day trading the indexes. And what I'm saying to you is if we catch a day trade right and we're making money into the close and we have a cushion, generally we'll book 50% of the gains on that day trade, but we could carry a position overnight if we have the right setup, because it could lead to that swing trade I'm talking about. So we may do that. And of course, I'll be sharing it with you under the hashtag and Slack room portfolio updates, because I'll tell you, we're on this trade from the morning. We're making money all day. We're going to carry half of that overnight and make it a swing position. That hasn't happened yet, but I recognize it could be a double bottom. And so that will be our first step. If we get that trade right, and then we see risk monitor go green, we'll already have our index positions on and we'll start filling out the portfolio with other individual stocks. That'll be our approach. So then we look at SpotGamma information this morning, and it's telling a more negative picture. This is why I use the two things together along with the ARMR algorithms. So in a bull market, in a risk monitor green situation, in a positive gamma situation, you see gamma rolling higher, volatility compressing. And that's what leads to long-term bull markets. I mean, things that just grind higher day after day. You look back and say, wow, the last 17 days, the market's been up. There's only been 2 down days. I mean, those type of markets are created with a compressed volatility and gamma levels that roll higher, okay? We're seeing the exact opposite right now, which confirms the bear market we're in. So we're seeing levels on gamma roll lower, particularly today, from 43 to 4,200, from 44 to 4,300. So the put wall drops to 4,200. The largest gamma location goes from 44 to 43. So this is all pressure on the market. So while we could get a rally this morning, we're going to get a rally this morning, the gamma structure would tell us we should definitely test support this morning, right? This is not a structure where the market should gap up and go. So that won't be the play we're looking for in the ARMR playbook. If the market gaps up and runs, we'll be looking to short that. I'll go over that in a minute. So before I get off the market topic, risk monitor still red. Possibility of a change if we make a double bottom down here. We're open to carrying some index positions if we get that type of a setup overnight. We're not buying anything right now from an individual stock name. We're not bottom fishing, none of that, okay? You don't have to call the absolute bottom in the market, okay? It doesn't make a difference if we get the absolute bottom in the market. What we want to get is involved in the trend change early, and there's dramatic upside from there. The only reason why somebody wants to call the bottom is so that they have they can feed their ego and think that they've done something great. But ego's got nothing to do with investing. We need to protect capital first, then we capture upside. So while it's fun to call a bottom, so I can look back and tell everybody on YouTube I called the bottom, that's not how you run money. I don't care about calling the bottom. All I care about is putting my capital to work when rewards are at their highest versus the risk I'm taking, and probabilities are at their highest, that entry point can last. So I don't have to flip-flop. Okay? Now, what I do in times like this is I spend a lot of time on my whiteboard really reordering it. And you guys can go to the website. because I'm updating the website as I go, right? And so the whiteboard right in here, you click on it. And of course, I do this in the Slack room all day, but then I update it on the whiteboard on the website so everybody can see it, because maybe not in the Slack room, but also just as like a final total. So what I'm doing here is I've got a list, these blue names. This is the list of the top shelf for me. Okay. And what I'm saying with that list, you can go look at it in a minute. I just posted it down here for you in the Slack room. What I'm saying is that I'm looking for relative strength leaders. The best part of a bear market is you can really see what institutions, what stocks and companies institutions are supporting, because they perform relatively better than the market. So one of my favorite screens, and I use William O'Neill MarketSmith, one of my favorite screens I created is a screen that shows relative strength breakouts before price. The theory here is that if the relative strength goes to a new high and you're in a bear market, the price is not going to a new high because everything's going down, right? But the relative strength is going to a new high. That's a leading indicator that the minute the stock market stops collapsing, that stock's price is going to follow its relative strength and make a new high, break out. So the tricky part here is you don't want to overload your top shelf list with companies that are, you're looking for relative strength leaders in beat up sectors. You're not looking for relative strength leaders in the overall market right now, because those are the stocks that are collecting capital when everyone's panicking everywhere else. And when the bull market gets started, those are the stocks that fund the bull market. All of that money comes out of those names back into the beat up sectors. So this is very tricky. You can't just look at relative strength and say, oh, these stocks are up huge. I don't want the stocks that are up huge. Those are the stocks that are collecting capital as the market's going down. So when the market starts to go up, those are the stocks that fund the rally, and they go down. So what we're looking for is a list of relative strength names in beat up sectors, like the technology sector, like the innovator sector. Which technology names, which innovator names are performing relatively better than their peers? Those are the names that institutions are supporting. Those are the names that go to new highs first. So I'll just give you an example of a chart pattern that would be at the top of that list. You got to put AMD at the top of the list. Okay. So let's go look at the higher low that AMD is making right on the 200-day moving average. Now let's go look at the index that closest resembles AMD. Notice how AMD is making a higher low at the 200-day moving average. But notice how the triple Qs are either they're going to make a lower low or they're equal to the low, right? So they're not making a higher low. And they're below the 200-day moving average. So this is the easiest way to explain the list that I'm looking to build. The index that AMD the index that AMD follows is represented by is the NASDAQ 100. That index is equal to the lows of January and trading below the 200-day moving average. AMD, and go look at the chart again, right, is trading above the 200-day moving average, this green line and this gray line, and it's making higher lows. Okay, so we're looking for a list of companies like that in the technology space. Higher lows above the 200-day, it's performing relatively better than its peers. So we build a list like this. We have to watch the list closely. AMD could crater in the next couple of days, take out the lows, and it comes off the list. It's no longer performing in a relatively better way, right? You see what I'm saying? So, and other names will show up on the list. Other names will pop up on the list. And we keep refining it. And then when we get risk monitor green, boom, those are the names we run to first. And we see which ones are set up that day for purchase and investment. All right. Just a couple more examples for you. Here's Sienna. I mean, Sienna, look at the higher low Sienna's making. That stock looks unbelievable. All it did was fill the gap in here. Technology names that look great. How about Cisco? Right? Double bottom at the 200-day, higher low. Stock looks great. Right? Earnings are blowing out. How about Expedia? Holy smokes. I can't believe this stock's performing like that. Right? A lot of semi stocks are holding up. Marvell is close to breaking, but who knows? It's still above the 200-day holding up. How about Micron? Definitely holding up. Could be forming a cup and handle. All right. Ares is old friend. Norton LifeLock. Ares made the money on that rally, got out, booked his profit. Well done. Stock's coming down. That's great. Makes a higher low, continues in an uptrend, could have a whole nother setup. NVIDIA maybe holds up. How about PTSG? Here's an innovative stock. The innovative stocks have been destroyed, and this thing is holding above the 200-day, making a higher low. So those are just a couple of examples. All right. So those are my thoughts on investing. Build your own list of relative strength leaders in beat up spaces and watch how they perform, because that'll be the best list for us to buy when this is all over and we're putting money back to work. All right. Let's dive into our day trading screens again. So for those of you who are following along during the day in the ARMR Pro live trading desk, we're trading the indexes aggressively. The trade that's been making us money, and I've been describing the last couple of days, is the flip trade. So in the morning, we always are looking long. I always rather day trade from the long side, because over an extended period of time, you'll realize that that's where all the money is. There could be finite windows like the last couple of weeks where all the money's short. Okay, but if you fall in love with that process, you're going to miss massive upside on the long side, and in many cases give away all of your short gains because you'll keep fighting the market thinking you should be short. Okay, so you've got to avoid that black hole. So the flip trade, to me, and I'll go over it in a minute, simply is helping us fund. It's helping us fund the long trades we're looking for. So we're getting long trades on. If we take a loss because a stop is hit, we're short on the same bar. So we're long the S&P and we get short the NASDAQ and the small cap on the same bar, make our money back. Okay, whatever we've lost, we make back, plus whatever we can capture on that initial sell-off. Book the profit, so we have profits overall from the long and short trades, and then reload on the long side to capture the rally. And what we did yesterday, we executed this to perfection in all humility, and we made money long and short. And that's even better. I mean, some days you make money long and short. So let's go look at it today, and then I'll share with you what my expected trade is today. So let me just go like this, blow this up for you. Okay, so what we see here. So these are 3-minute bar charts. That's what you're looking at right now. The NASDAQ is enhancing for you right here. This is the S&P over here. Each bar is 3 minutes. All the lines are the ARMR the ARMR price movement profiler, which is our day trading algorithm, except for these purple dashed lines, which are the SpotGamma locations that we try to trade. Okay, so the green box is where we get a risk on buy signal. Market gap down, we put money to work, it rallied up. There was actually a profit there. Depending on how you traded it, you could make money on that first move higher on the day, right? So we put that position on, some money could be made right there, all right? On this bar, we exited. So when we're getting stopped out of a position, you go right over here. This pink box is where we got short the market. So we flipped the trade. We started long. It doesn't work. We get stopped out, in this case for a profit. We get stopped out, okay, because our stop was tight. We raised it when we made that double top in here, all right? And we immediately when we get stopped out of the final part of our position, we're getting short for the flip trade. It sold off all day. You can trade that. You can hold that short all day. It never closes back above the first standard deviation below the VWAP, which is this yellow line. The same thing happened right here. So when we're going short the NASDAQ, we're also going short the small cap index. Sells off, never gets back above VWAP, keeps breaking down. You could have stayed short all day. I hate losing money on the short side. So sometimes I'm a lot quicker to book profits on shorts. All I'm looking to do in the flip trade is make what, in this case, we'd already made money on the long trade. But had I lost money on the long trade, what I'm looking to do is make that money back and get whatever I could get out of the short trade. And the minute I think the trade may be over, I book my profit short. Okay. But there's nothing wrong with staying on the short side all day on this thing. I mean, the NASDAQ never closed above the first standard deviation below the VWAP, which is what your stop would be, right? And in this case, the small cap never closes back above the VWAP. It breaks below the first standard deviation. And the time you would cover this position is when it breaks above the first standard deviation right here, which is right here. You know, of course, you can also cover as it's going lower and hitting targets, okay? And so then what we did is right here, we're getting long the market. So if you were short all day from this entry point, and we're getting long right here, you're definitely not, you're out of your short for sure, right? And we captured this long trade right up here. All right. So that's what we did yesterday. And we've been doing this almost every day the last 2 weeks. We've been putting trades on and then flipping short, making money short. Yesterday we made money long and short. I think there's a couple other days we did that in the last 2 weeks. So what I'm looking for today, I'll always put the flip trade out there when we got risk monitor red and a negative gamma environment. It's no difficulty for me to put a flip trade on. I get long and then I go into the market and I set up sell stops that automatically trigger if the market reverses. If the market keeps going up, I'm not short. That's great. I just make money on the long side. But I put those orders into the market. So I'm long the S&P. I focus all my firepower on the S&P right now. And I put these sell stops in NASDAQ and small caps so that, particularly in a news event-driven market, if there's a story that wrecks my long trade and I'm getting out of the long trade, I'm getting short and making money short immediately. This is a news event-driven market with negative gamma. So a piece of news hits and the market just implodes. So the short sell stops I have in the market are to protect me. And it helps free up my hands to throw punches and get long. Because somewhere in here, we're going to get long and have a huge up day. And we're going to carry that overnight and it's going to turn into a swing trade. So I keep searching for that trade. And I protect myself with the flip trade and it's working really well. So this morning, the market's going to gap up. The trade out of the playbook that I would expect on a gap up, the market's going to open somewhere up here. I'm going to look for a sell-off that tests this new uptrend, right? Market stopped here, made a higher low at the close. Now it gaps up, pulls back. If it holds that little uptrend and gives us a buy signal, I'm going to hit that pretty hard. All right, and I'm looking for that to happen in that 10:30 to 11:30 window. That's the number one play in my playbook. Something else could develop and I'll trade it. But I'm just telling you, if you go to the ARMR playbook and you go to the website and you find that and you click on it, you see all the plays. The play I'm looking for is a gap up, pull back that holds the support and gives a risk on signal. And I hit that real hard and at the same time put the flip trade out in the market to protect myself. Okay? I think that's all for today. Any questions you guys have for me? If not, I will see everybody on the live trading desk at 9:15. And I wish you all a good trading session. Let me see if there's anything. Yeah. Okay. So a question about cannabis from Chad. So let's go over cannabis again. Oops. All right. So I can't wait to own MSOS again. But you have to admit, looking at this chart pattern, that it did not break the downtrend. It tried 1, 2, 3, 4, 5 days. Tried for 5 days to break the downtrend. Then the market fell out of bed and it follows the small cap index. So if small caps get crushed, it's very hard for the smallest of the small caps to trade on the Canadian Stock Exchange to go up. And that's what MSOS is. Okay. So now what we're looking for is a higher low. Oh God, Chad, if this thing can make a higher low, reverse and go back above the 50, I'll put on a full position. Okay. I won't, before we were putting on small position sizes and I'll increase it if blah, blah, blah. If this thing makes a higher low and has a reversal day that takes out the 50, closes above the 50, my full position will be on and the low of that day will be my stop. So I'm watching, I'm waiting. I can't wait to do it with you. As you point out, the news cycle continues to get more bullish for these companies. So I'm happy to do it. I can't wait to do it. It's just not the right time right now. Also, one last note. You guys didn't remind me, and I wanted you to remind me. Okay. We are using XOP and GDX to hedge our energy and precious metals positions. All right. So when there's the opportunity, in other words, when they go up big in the morning, we're going to put sell stops in the market so that if they reverse and the stops get hit, we get short. So we look at the first half hour of trading, really maybe 15 minutes to half hour of trading to see what the setup is in those two ETFs. We put sell stops into the market and we walk away. If those assets keep going up, great. But if they come in, we're going to get short. We did that 2 days ago and made money. I didn't do it yesterday, and I was very disappointed in myself. So I'm doing it every day to hedge those positions. Okay. Dennis says, when should we get some TQQQ? I'm not trading the triples right now. I only trade the triples. I only trade the triples when there's risk monitor green and a positive gamma environment. So I'm only trading the doubles right now. QLD is the double version, okay, of TQQQ. But you can do whatever you want. I mean, the reason I'm not trading triples, Dennis, is that I don't like the behavior of the triples when the market starts going down aggressively. And I've even noticed when let me put it this way, when volatility has spiked, which it is, and remains high, the ability for the triple ETFs to use futures and options to express the correct price is on a delay. So while the triple Qs might hit a target and I want to go book a profit, I go look at the TQQQ and they haven't moved. It's like, well, what? And that really bothers me. I can't do it. In a positive gamma risk green market, they might overshoot. We might hit a target on the triple Qs and TQQQs has gone higher because of what's going on and the nature of the beast. So anyway, I'm only using the doubles. And when you're asking me, when would we get long the Qs? You can get long the Qs whenever you want. What I'm doing in this market is I'm firing all of my firepower, focusing all my firepower on the S&P. It's the most liquid index with all of the ideas. I don't need the extra juice of the Qs on the upside right now. Number one. Number two, it's the index performing better than the Qs. The Qs are the index under most attack because of interest rates going up. So I'd rather focus on the S&P right now and use the Qs to hedge my position, which is really working. So I'm shorting the Qs and I'm going long the S&P. You could do whatever you want, but so don't, do whatever works for you. I'm not saying you can't make money trading the Qs. You certainly can. You absolutely can, right? But I'm just telling you what works for me emotionally. Okay. It helps me set up trades correctly. I put my flip trades out there and I can put a lot of money to work. And I'm not missing anything on the upside right now. It's not like the S&P can't keep up with the NASDAQ at the moment. It's actually the opposite. So anyway, so I hope that answers your question. And again, you can do whatever you want. I'm just sharing with you in this market. When the risk monitor turns green, then I'm happy to own all the indexes. I'm going to get long the S&P. At the end of the day, the market will be up huge. I'll have a day trade that turns into a swing trade. And the next day, I'll be looking to get long the Qs and long the small cap and long the Dow because I'll be looking for a swing trading rally. But I'm not there right now. All right. Okay, guys, have a great trading session. I'll see you on the flip side.